Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 229, Understanding Options. Cory, thank you for joining me back on the show.
Thanks for having me.
Of course, and thank you to all of our listeners and viewers out there. Extremely humbled. Our subscriber count continues to grow. Our listens and view count continues to grow. So if you're not already subscribed to Upticks on your favorite podcast platform, I'd highly encourage you to do so. And if you're not already subscribed on YouTube, that's the best way to make sure you don't miss an episode, is just go ahead and hit that subscribe button. It doesn't cost anything. But all that's going to happen is YouTube's going to let you know when our next episode comes live. And we crank these suckers out about once a week. So it's been pretty good as far as that's concerned. Cory, before we dive into, this is now our third part on the investments. We've talked about stocks. We've talked about bonds. Today, we're going to talk about options. But before we go into that, do you have anything personally you want to share? Anything cool going on in your life or anything new since last week?
No, I don't think I have anything to share. How about you, Jake?
Nothing?
Not too much.
You know, I'm reading. Okay, Cory, you're a closed book this morning. So I am reading this really good book about John Rockefeller. And Chernow is the author. In this book, Cory, is, for my subscribers on Upticks to my email, they see that book on there every week, because this book is, this thing could be a doorstop to a huge, heavy, swinging door. This book is thick, but it's really fascinating. You know, this guy, he crushed it in the oil business in his 20s and 30s. This guy was making $1 million deals in the late 1800s. It's unbelievable. He was a little bit ruthless. I think he held himself out there as this, guy that thought he was better than everybody else a little bit, but you can't deny his work ethic. And you can't deny his foresight. So anyways, do you know much about Rockefeller?
Not too much. I know that reading a Ron Chernow book about him would tell me anything and everything that I need to know, because I know they're incredibly detailed.
Yeah, it reads like a novel. It was pretty cool. But, it's just, so I'm probably only, a third or maybe a quarter of the way through it. But guy crushed it in his 20s and 30s. He's just buying up all these oil refineries from Cincinnati, believe it or not. I didn't know that. Mainly in Cincinnati.
That era is a really interesting one. Just everything about it, like I guess the late 19th century, the late 1800s. I think that was really what was considered the Gilded Age of architecture. It's when the World's Fair was in Chicago. That's a really interesting time, and a lot of ways to read about.
Yeah, I think that was Vanderbilt's heyday. All that money going around, and so it's pretty crazy. But anyways, good books. I've been enjoying that. Yellowstone is at its mid-season break. That's been a really good series. One thing Rachel and I have been watching is College Bowl. Have you ever watched that show?
Never even heard of it.
College Bowl is hosted by Peyton Manning and his brother Cooper Manning.
Yeah.
And it's a quiz show for college kids. And these kids are smart. And there's schools like Columbia, Penn State, Georgia, Texas, OU. So it's a pretty cool deal. Rachel loves trivia, so that's why we're watching it. But that's been fun to watch. So you got nothing else to share before we dive into options today?
I thought about it while you were talking. One thing that I did neglect to share, a TV show actually that Cassie and I just watched, was the show Severance, which was really good. Very interesting. Yeah,
I heard that's really good. Rachel likes it, but I haven't watched that one. So
it's really original, and I think it's really kind of like a metaphor for, there's a few metaphors at play, but the whole concept of work-life balance, like these people literally get chips installed, they get chips put in their brain. So they go to work, and then when they leave work, they have no recollection of what happened. So the idea, at least, is that there's a true split of the, ever elusive work-life balance. But there's a lot of unintended consequences that come from that. It's really interesting though. I bet you'd like it. It's really original. One of the more original things I've seen in a long time.
Yeah, Rachel claims that I would like it. I couldn't do that.
Get a chip put in your brain for work-life balance? No, me neither.
Or I can't, and I talked about the team about this. I can't separate from being an advisor. It's part of who I am. It doesn't mean that I'm always working, but like I joke with my team that, if you're on an airplane and somebody's having an issue and they say, hey, is there a doctor? If anyone ever had a financial issue on an airplane, I would say, yeah, I'm a wealth advisor. I'm here to help. Like I can't help myself. I take my job that seriously. And I think most of our team does also. But again, I don't leave work and just completely unplug. I love what I do too much. I love helping people. I love personal financial planning, and I love the financial markets. And that goes into everything what we do. So
I think that concept, though, part of what makes it interesting, at least for the purpose of a TV show, Jake, is that it's really people that are troubled in their daily lives, or they have some sort of trauma or something has happened to them that they basically just don't want to think about 8 hours a day. So that's what they choose to do. And that's kind of why they do it. But anyway,
interesting.
Pretty good.
All right. Well, good. Well, thank you for sharing. I finally got you to open up here a little bit. And Einstein made a little cameo. If you guys saw him in the background, he likes to hang out during these podcasts. So, and as everyone knows, we're recording these on Wednesdays now. Those are our development days. That's when Cory and I really do research, podcasts, financial literacy, education. That's what we really focus on. So that on Mondays, Tuesdays, Thursdays, and Fridays, we're in the office advising and meeting with clients. So you can think of it as today, we're out of the office, being very intentional about what we're doing. And the other 4 days of the week, we just want to be zeroed in and focused on our clients, meeting with clients, giving advice, calling clients, Zoom meetings, however they want to do it. So that's what we're here for. So again, thank you all again for tuning in. So today, though, we wanted to talk about our third part of, basically this investment series that we've created. We started with stocks, then we went to bonds, and now we're on to options. Now, I want to be very clear here, and I want to be, it's very important as a disclosure that we are not recommending anyone take any of this as investment advice. I don't want any client or any random person that's watching this episode to go think they can trade options after this. Options are a great opportunity to potentially enhance a portfolio's return. But as we know, Cory, that doesn't come without risk. And options are very dangerous because if you put a trade on incorrectly or you don't know what you're doing, you can literally wipe away thousands or millions of dollars if you're not careful. So again, this is very important to me. I only think people should be doing options if they're working with a licensed professional that is doing it for them, frankly, or advising them on how to do it. Because again, you put one trade on wrong, and next thing you know, you're losing a ton of money just because you put it on wrong. So very careful, not something that, again, you want to do alone. But we use options, and let me just explain what one is, because I've defined a stock, we've defined bonds, Cory, but an option is a derivative. And so basically it is a separate contract that trades in Chicago. Just like there's a New York Stock Exchange in New York, there's literally the Chicago Board of Options Exchange. And by derivative, I mean that basically these are contracts based on different price and time movements. And for today's example, we'll use stocks, but there's all kinds of options contracts. So that's all it is. So you can think of it almost as another security on top of a security, right? And really what you're doing is you're putting a trade based on an assumption of price direction and volatility. And that's really what we're doing here. So the option value is based on time, price, and volatility. And so that's what we're doing. And I want to go over one version of option trading that we use, which is called a covered call strategy. But Cory, do you want to add anything before I go over one of the strategies that we use?
No, well, there's one thing I want to add. You talked about how an option contract is a derivative, and there's assumptions involved, and the pricing is driven by volatility and a few other things. But an actual option, whether you were buying or selling one, the value of it is really driven by whatever the underlying security is. That's just one thing that we didn't specify. It could be an individual stock, it could be a stock index, it could be cryptocurrency, it could be whatever it might be. But the whole idea is the option is tied to an underlying investment.
Good. Thank you. Yes, you're exactly right. So there's an underlying investment there. And every option contract represents 100 shares of that, in this example, stock, right? So for our clients, we typically only use options if they have $1 million portfolio or higher, just simply for the reason that you need to have hundreds and hundreds or thousands and thousands of shares for this to make sense. And so smaller accounts, it really doesn't make sense because you're not, if you don't have 100 shares, you can't even do it. And if you only have 100 shares or 200 shares, it's really might not be that much of a benefit to you. And so we typically start out at $1 million. Doesn't have to be, but that's typically where we start with it. And there, but again, every option contract represents 100 shares of the underlying security. Now, what I want to do, Cory, is I want to share my screen because I've got a very generic illustration that I want to go over because I think that'll help kind of illustrate this covered call strategy that I'm referencing. So let's go through this example. And if you're listening to this, don't worry, you don't need to see this. But again, I'll explain it here for the viewers and the listeners. So in our write-up here, we've got a generic example of, let's say a client, again, in this example, they have 100 shares of XYZ stock, and today it's trading at $40 a share. And this covered call writing strategy, and again, we didn't invent the name, but covered means that you already own the stock, and call means that you're selling somebody the right to buy it. So again, that's the writing piece of it. So we would sell one covered call option. And this example, it expires in April, but for our clients, we typically do it a month out. So if we were doing this in January, it would expire in February. If we were doing this in February, it would expire in March, and so on. So in this example, we would potentially be doing this in March. So the option would expire in April, and it would have a specific date. It would be April 18th or 15th, whatever it was. Typically, it's the third Friday, but not always, but typically it's the third Friday of the month. And in this example, if the stock is trading at $45, this option contract will be assigned. And I'll go over what that means here in a moment. Now, for doing this, the client would receive a premium in this example of, let's just say, $1 a share. So if you have 100 shares, you get $1 a share and you get $100. And so what you're saying is you are selling somebody the right to buy 100 shares of XYZ stock between now and your option contract expiring, we'll say April 18th or whatever, for $45. Okay, so today it's trading at 40, and you say, hey, if it goes to 45, I would be okay selling it. For that, you're going to get paid $100, and then we just sit back and wait. Now, did I miss anything there, Cory?
Nope.
Okay, good. You're following along. I know you already know how to do this, but I want you to listen to this as if you're a client hearing this for the first time. So good. So again, so that's the trade that we put on in this example. Now, the potential outcomes are anytime between the time we do the trade and the expiration, if your stock is trading at 45 or literally 45 and a penny, the holder of that contract has the option, again, hence the name, to buy 100 shares from you for $45. Okay, so they would exercise it, or you'd be assigned that contract. Now, if your stock never hits 45 and goes all the way up to expiration, well, then you'll just keep your 100 shares, and that option contract will ultimately expire worthless. Now, in either one of these potential outcomes, you would keep the $100 premium. Okay, so it sounds like a great deal, Cory, but there is risk, and the risk is, in this example, if your stock goes to 45 and a penny, for example, Cory, you don't get to sell it for 45 and a penny. You have to sell it for 45. In a more extreme example, let's say your stock goes to 100. Well, now you have to sell it for 45, right? So you wouldn't want to do this on a stock that you were hoping would double in value or shoot way up in value, because then you would potentially miss out on all of that. So there is risk in this example, but the reason we do it is that we want that premium. We want to generate extra income for our clients. And we typically do it on stocks that we feel have already somewhat peaked. So maybe a stock has already run way up, and we say, hey, Cory, if it goes up another 10%, that would just be icing on the cake at this point. So we'd be okay selling it. That's when we typically do it.
I was going to ask you just that question, Jake, of understanding what you just described. Or before you did that, I was going to ask the question of when does it make sense to do this, but you just answered that one. Let me just pose a different question though, because we're talking about it for anybody who's watching or listening. Understanding that someone has that whole idea here is we're selling the contract, but there's someone on the other side of that trade. They're buying the contract, but they are purchasing the right to acquire your shares at a higher price in the future. My question, Jake, is why would someone want to do that? Why wouldn't they just buy the shares at today's price?
Oh, I like that. Thank you for asking that and bringing that up. And so, sadly, in Wall Street, the people that buy these contracts are typically known as fools or suckers, and they're speculators, really is what they're doing. And so, Cory, for them in this example, it's a lot cheaper for them to shell out $100 versus in this example, it would have cost them $4,000, right, to buy 100 shares at $40. So they could either buy the stock for $4,000, 100 shares, or just pay $100 and then turn around and flip it or whatever if they think it's going to go to 45 or higher. So typically the people buying these contracts are people that are speculating or don't have as much money to invest, or sometimes they're big institutions that are just doing it as a hedge because they're short that position or something. So there's a myriad of reasons that people would do it, but the broad reason is that it's cheaper, right? That they're just saying, hey, rather than risk 4,000, I'm only risking $100, and if I'm wrong, I lose $100. And so that's why they would do it. We typically don't buy these contracts because, again, the only way for them to make money in this example is that the stock would have to go above 45, or they lose their whole $100. And we don't like to do that. We like collecting income for our clients, especially our clients, because our clients are typically high net worth and they want income from their portfolio. They've already made, their money, and they just want to protect it and grow it. And income is one of the ways that we can hopefully do that. And so that's a really good question, though. And that's the person on the other side of the trade. And there's also what's called a market maker. So there's not always necessarily a physical person buying it. Sometimes someone is just, there's literally a market maker buying that contract, and then they go turn around and sell it. So they're making an efficient market for these contracts. But again, it's a very complex strategy. And again, it's not, because if you put a put on instead of a call, or you sell instead of buy, or whatever we're doing here, you could be risking something that you don't want to risk, is my point. And so that's why it's very important that you work with a trained professional who does this a lot and can watch it for you every day. Good. What else did I leave out here?
I think, from my point of view, Jake, another reason for using a covered call strategy, or a benefit that it can provide from my point of view, is that it can also, frankly, selling a covered call can force someone to exercise some discipline around when they sell a certain company. For example, in the XYZ example at $40 a share, we're human. We think in linear terms. If we own something at 40 and we say, when it gets to 50, I'm going to sell it. But when it goes to 50, it's not out of the norm that people say, well, maybe I'll wait till 55 or 60 to sell it. This is a way to execute, really just force some discipline upon an exit price if there is a company that you want to sell. And then, of course, Jake, I don't know if you want to talk about the option to roll a covered call contract and what that can mean for individuals also.
Yeah, good. And thank you, Cory, for bringing that up. You're absolutely right. Fear and greed, right? They're big drivers of influence of people's decisions. We don't like using fear or greed because they can be harmful to a well thought out financial plan. So you're right, Cory, this will lower that greed influence. If you say, look, we agreed that $45 was an appropriate price, let's sell it, because that's what we agreed to when we did it. Hindsight's always going to be 20/20. And sometimes you're going to kick yourself and say, wow, Jake, it went up to 50. Why did we do that? Well, it was already at 40. Maybe it went from 20 to 40. And we said, look, 45 would be great. But that's another good point. And a little bit more complex, Cory, like you mentioned, is you could roll the option. So not all is lost. If the stock shoots up to 50, this isn't always the case, but sometimes we can roll that option, which means we can basically buy it back and sell a new one. So that you're not forced to sell. So that is something that we look at, but I don't want people to count on that, because that's not always the case. But it certainly is an option to looking at things. And our traders will look at that before just letting an option exercise or be assigned. So like I said, and hopefully people are picking up on this, there's a lot of nuance to this strategy. I want to talk about, though, also quickly, Cory, that there's a lot of situations where you can't even do this. So if your advisor is using mutual funds or annuities, there aren't option contracts on mutual funds or annuities. You typically can't do this in a 401k either. And so, so you have to understand that if you're working with an advisor that's just slapping you in products and mutual funds specifically, you don't have the opportunity to do this. And so to us, we think that's a huge miss, because for the right client with the right goals and objectives and managed correctly, this can be quite an enhancement from an income perspective to their financial plan. And we're talking about $10, $20, $30,000 a year in potential income that they could have just by literally using stocks and options versus just slapping in a mutual fund. And so again, it's not perfect. There is no perfect strategy, in my opinion. This is just something that we do as an overlay to our stock and bond allocation for the clients that understand it, are willing to take the risk associated with it, and want to potentially get a little bit more income. And that's what we use it for.
Perfect.
Yeah, it's really good. Anything else we missed? So again, it's a complex, but I just wanted to roll this out softly to clients. A lot of our clients are doing covered calls, and so I think this is a good refresher from when we initially educated them on it. There is a website out there called the Options for Industry Council. They've got some good videos. And again, this is technically called a covered call strategy. There's a ton of different option strategies. I don't want people to get overwhelmed by it, but what we're talking about today is the covered call strategy. And so if you want to go educate yourself and go a little bit deeper, I think that's a decent resource out there. Again, I'm not endorsing them, but they're the Options Industry Council. So I don't think there's worse places you can go to get education on options. Anything else, Cory, as we wrap up today's episode?
I think just one more question. I don't know if you can answer this one on the show, Jake, but I'll ask it anyway. My question is, if someone were to run this strategy, do you have any kind of expectation for how that should enhance the return? And obviously, there's a lot of things that can impact that, but I'm just curious if a prospective client had that question. I'm just curious how you'd answer it.
Yeah, it depends on the year, right? So just like that's like saying, what do you expect to earn out of stocks? I mean, some years will do better than others. Like I said, if you've got $1 million, we're making you 10,000 more than not doing it, and we don't charge any extra to do it as our overlay. Like Charles Schwab, our custodian, does charge to do this. We absorb that cost for our clients, so it doesn't cost the client anything extra. So if they could potentially make another $10,000 in a normal expected year, then to me that's worth it, right? And if we add that up over a 30-year, retirement, that adds up to a lot of money, and that's why we like to do it. So it's singles and doubles. Again, it's literally making hundreds of dollars here, hundreds of dollars there. We add it all up for the year, and hopefully we make around 1%. But again, there's no guarantee. Doesn't always happen that way. But that's what I would tell a client, that's what we're looking to do. That's what we're looking to accomplish. And if we can accomplish that, we'll feel like that was a successful year.
Very good. And is there a certain type of market environment that it's best typically to use this strategy in?
Yeah, good question. So typically, the more volatility, the better, believe it or not, because you get more premium. And typically, if the market trades sideways, meaning it kind of just does this, or even down, believe it or not, this is probably the best environment for that. A market that just keeps shooting straight up, this strategy has a little bit more difficulty making money, because those stocks will keep going up, and it might not always work. So believe it or not, I feel like when the market's going straight up, everybody's happy because they're making more money than they expected anyway. So that's why we like this, because in flat or even down markets, this strategy should, in theory, perform a little bit better than not doing it. Again, it's not perfect. There's no guarantee, but that's the environment where we would expect this strategy to do the best in.
Great.
Good questions, Cory. Yeah, thank you for bringing those up and joining me. And again, as always, we don't want any client or any random person watching today's show to go try to do this on your own. If you do want to have a follow-up conversation about options, certainly feel free to email me. I'm happy to share my schedule with you. My email is jake@falconwealthadvisors.com. Cory can talk to it as well. Obviously, his email is cory@falconwealthadvisors.com. We also have 3 investment management individuals or professionals in our group. They're the ones actually doing the trade, so they're very familiar with the options markets as well. And that would be Connor, Matthew, and Abby. They're also available to you. You simply just need to email service@falconwealthadvisors.com to get one of them to talk with you. So again, our whole team at Falcon Wealth Advisors is here for you as always, but we specifically want to get into options. We're happy to do that as well because we love them. Again, we think that's a lot of opportunity. We think it's a nice overlay. If we're already doing individual stocks and bonds, why wouldn't we take advantage of trading options as well?
Excellent.
Well, good. Well, thank you, Cory. This does wrap up our 3-part series. We will be rolling out new episodes as 2023 progresses. Please make sure that if you haven't subscribed that you do. We do plan on bringing on guests. It won't just be me and Cory every time. So again, we're going to plan on rolling out some guests here in the coming months. So that should be fun, Cory, for you and I to host some people as well. All right, good. You have anything else as we wrap up?
Nope. Thank you.
All right, perfect. Well, thank you, Cory, for joining me. Thank you all for tuning in, and we hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.